Thank you all for joining us. We're going to get into this webinar, and with me today I have our senior analyst in oilseeds, Tori Alden, and he's going to take us through the impact of the coronavirus in the vegetable oils market. So with that, Tori, this is going to be a regular series, correct? We're going to be going after this maybe once a quarter?
Yeah, thanks, George. We want to start doing this once every 3 months, so we'll schedule the next one for probably late October. But if you're here, I'm sure George and the marketing guys will get you an email reminder well before the next one. But we want to start doing this on a regular basis. So if you have any comments beyond sort of questions or whatever, please let us know. We're happy to get any feedback that we can get. And with that, we'll start. Okay, so the impact of the coronavirus for the vegetable oil markets was really kind of felt in a significant shift in consumer preferences. So this chart kind of shows you food dollars or dollars spent on food away from home and dollars spent on food at home. And as you can see, in preparation for the lockdowns, we had sort of offsetting changes where people quit eating out, but then they went to the store and stocked up on everything. That didn't keep total expenditures unchanged. They declined a little bit. And then as a lot of the country locked down to try and slow the spread of the coronavirus, you see a sharp drop in food away from home expenditures in April and in total expenditures. It looks like that probably was the bottom, and we're going to start to build back towards what will become normal. One of the big questions, though, and one of the things that will have a pretty significant impact on the oil markets going forward is the number of restaurants that have closed. How many of those actually can come back? How many of those can survive the shutdowns for the length of time and then can actually reopen, and how many of them will be permanently closed? There may be some offsetting formation of new restaurants if we get a vaccine and everybody's confident and everybody goes back to eating out as much as they used to. We certainly have seen in areas where the lockdowns have ended that there's pretty significant demand even at this point for eating out. I live in Florida, which obviously is going through a pretty tough time right now. And I've got to say, just anecdotally, there are still a lot of people eating out at restaurants when I drive by. The capacity is limited, but I assume that once this is past us, that people will go back to eating out as much as they used to. And ultimately, that blue line will shift back up and continue the trend that it was on before the pandemic. In biodiesel, the changes were a little bit more subtle. We all expected biodiesel production to slow down pretty dramatically, and we built our forecast to assume that, and we really haven't seen that for biodiesel yet. For renewable diesel, we did see some slowdown. That's starting to come back, but domestic biodiesel production never really slowed down that much. What we have seen is a shift in the feedstock mix, in part because of the dramatic slowdown in ethanol production limited the supply of corn oil. So you can see corn oil dropped off pretty dramatically, but then you had soybean oil and canola oil replace the lost corn oil to keep production at a relatively steady level. Going forward, we're building back in a recovery in ethanol production that will increase the supply of corn oil. That'll take a little bit from soybean oil, and probably more from canola oil, just because of the relative value of the two feedstocks. For non-biofuel usage, we saw something that's kind of similar to what you might expect given the first slide. You see that there is a very small reduction in usage in the first quarter, Most of the impact is in the second quarter, and then we expect it to recover in the third quarter back to about first quarter levels before starting to build again in the fourth quarter. Of course, all of this is dependent on the development of the disease and whether we get a second wave that forces more closures. But the big impact probably will be, or the biggest impact probably will be on just in terms of total usage will be on soybean oil, which dropped down about little less than 10% and is expected to recover. What you also see here is that the impact on canola oil was not that dramatic, as a lot of the usage that was lost in restaurants was made up in people stocking up. The palm oil series is much more a function of, it's a little bit a function of the pandemic, but I would argue that it's probably more a function of the relative price of palm oil compared to soybean oil. That spread has fallen to historic lows, and that makes palm oil significantly more expensive relative to soybean oil, and that's what is hurting the palm oil usage. So we expect that spread to widen back out, and that takes palm oil back up outside of whether we get a recovery from the pandemic. U.S. soybean crush has been really robust. We've seen monthly records for the last 7 months, and that is the third longest period of monthly records. The longest was in 2016 at 16 months. And this has occurred despite crush margins that have not been really as high as they were even last year. And so as crush margins recover, we expect that crush will remain strong. We don't expect the records to continue through the end of the marketing year, and then we expect next year's crush to remain at about the same level. But it will keep the soybean oil market relatively well supplied, since we crush really for soybean meal and then sort of try to do whatever we can with the soybean oil afterwards. One thing to note is that in April, there were anecdotal reports suggesting that because crushers were crushing and because some of the food companies had stopped picking up their monthly shipments, that some of the crushers actually slowed down crush because they didn't have enough storage to continue to produce soybean oil. We checked around, and that seemed to be probably limited to 1 or 2 crushers. And as you can see, it didn't have a huge impact on crushing volumes. And from what we've heard, to the extent that happened, it was really, really a short period, 1 or 2 weeks in April. And now things are generally back to normal. For the little bit longer forward outlook, this is per capita vegetable oil usage in the US. And as you can see, most of the per capita usage for the calendar year is expected to be down this year. You can see that in particular, corn oil, that's like we said, that's a supply issue, and palm, due to the spread, those were the biggest declines, or are expected to be the biggest declines in 2020. Soybean oil is relatively steady, and canola oil, like we showed in a prior slide, didn't really experience much of a slowdown, and we actually expect per capita usage to continue to recover from a little dip that it had there in 2018. For 2021, we expect soybean oil kind of to continue on the same trend, canola oil to accelerate with the recovery in the economy, and then again the increased production of ethanol providing more supplies for corn oil, so corn oil recovers, and a widening of the spread between soybean oil and palm oil to drive a recovery in per capita usage of palm oil in 2021. Shifting to exports, U.S. soybean oil exports have been really strong this year, much stronger than we expected or the USDA expected at the beginning of the marketing year. Part of the reason has been due to that spread between soybean oil and palm oil. When the prices reach sort of close to parity, you'll have a lot of smaller countries that will switch from palm oil to soybean oil, and that has fueled soybean oil shipments to a lot of places that we typically don't see take U.S. soybean oil. But we've also just seen strong world demand from the big importing countries like India and China. They both were a little bit deficit probably coming into the year, and we'll talk more about China and their issues. And they've worked to rebuild those stocks. China is really the country that recently in the past month or so has driven a lot of the price action in the world vegetable oil market, in part because they made some pretty big purchases out of South America, and that has sort of limited the supplies that were available now, but also, as we'll talk about a little bit later, has some implications for what's going on in Brazil and Brazilian crush that could have an impact on not only the potential for U.S. soybean oil exports in the coming months, but maybe the U.S. soybean exports in the coming months. In Canada, the canola crush looks a lot like the U.S. soybean crush. They are absolutely smashing their record crush volume this year. It looks like the 1920 crush volume total is going to be 10.1, just over 10.1 million tons, which is about 800,000 tons above the prior record. Again, the relatively steady demand for canola oil or strong demand for canola oil, both domestically and in the export market, has really provided support for those crush volumes. And you can see that based on the weekly crush data that we get, it looks like there's a little bit of tick down in July, and that contributed to just a massive rally in Canadian canola oil prices that have gone up $100 in the month of $100 per ton in the month of July, and peaked at $950 per ton last week, after jumping basically about $100 per ton in a week. And so you can see, despite the fact that the Canadian crushing industry has been operating at or near full capacity, the demand is there for canola oil. Like you've seen in the prior slides, we expect that demand to continue, and so we expect crush to remain strong. There's a little bit of uncertainty about exactly where crush will be next year. We're a little bit above USDA right now. Not quite as high as we are this year, but I wouldn't be at all surprised if, as we move through the marketing year, we continually raise our crush forecast, depending, of course, upon the crop size and how the Canadian canola crop finishes out the marketing year or the growing season. In Brazil, you can see this is a chart that I've used over the years, in part to demonstrate the fact that it's really Chinese soybean exports that have driven the expansion in Brazilian production. You can see how well those two series line up. But this one also shows that there has been a pretty significant uptick in soybean oil imports in China from Brazil. Like I mentioned, over the last couple of months, they've made some pretty big purchases. And that just kind of illustrates sort of the fact that if China decides to buy soybean oil or needs to buy soybean oil, they do it in a relatively large way, and they can have a significant impact on world markets. a lot of the reason that we've seen the rally in vegetable oil prices over the last couple of weeks started in China, where the Chinese futures market just ramped up significantly higher over a relatively short period of time, followed by palm oil, and then followed sort of begrudgingly by soybean oil. Now, the fact that China has also taken so many soybeans from Brazil so far this year, and we expect, you can see that we expect a relatively large jump in total shipments of soybeans to China from Brazil, that may have some implications for Brazilian crush going forward. Brazilian soybean stocks are getting tighter by the day, and ultimately we think that Chinese buyers may have to sell some of the cargoes that they've bought back to Brazil in order for Brazil just to crush to meet their domestic needs. In addition to sort of the strong export demand, they've also raised their biofuel mandate to 12%. And so there's also strong domestic demand for soybean oil. And so the crush in the volume of crush that they need has become a little bit less optional. And so the question becomes, does China sell some cargoes back? Does Brazil import soybeans from Paraguay and Uruguay? Or do they import soybean oil from most likely Argentina? It's really interesting, and the ultimate resolution of that situation will play a large part probably in the level of soybean exports out of the U.S. in the 2021 season. So far, we've seen China buy a lot of U.S. soybeans relative not only to last year, but to the last 5 years for the 2021 marketing year. And so it suggests that we will have a big uptick in soybean shipments, but there still is obviously a lot of political tension between the United States and Chinese governments that could throw a big monkey wrench into that. If that happens and China decides not to buy U.S. soybeans again, then the question becomes, where do they buy soybeans, given that Brazil is basically out of soybeans and they're going to need more soybeans than they probably have to crush. And the Argentine crop isn't that large, and farmers are sort of notoriously tight holders of soybeans as a hedge against economic uncertainty. And so with that, we go to Argentina. You can see here that Argentina is expected, well, Argentina's soybean oil exports, although large relative to other exporting countries, are relatively steady. We expect that to continue, although again, there's the wild card of China in there. The Argentine crop was a good crop, and so in theory, Argentina may be able to help resolve some of this situation. But the question is, will farmers sell? Given that we've just had a change in the administration in Argentina, there is the potential for Argentine farmers to really hold on to soybeans because of fears of inflation. And so if they do that, it could keep the crush relatively tight. We've seen Argentine soybean oil prices rally along with Brazilian prices as China has bought and also as they've rallied off the lows from the coronavirus. If farmers decide not to sell, it probably will show up in those Argentine soybean oil prices. Right now, Brazilian soybean oil is at a relatively wide premium to Argentine soybean oil. So everything looks okay right now, but we'll see where we are in sort of a couple of months. In Malaysia, the big question really here is kind of where will production be? And right now, I honestly have changed my Malaysian ending stocks forecast more in the last 2 months than I have probably in the last 5 years, just because we got the June MPOB data that showed historically high production. And then in July, what we've seen are reports that have suggested that there's a labor shortage and that excessive rainfall was limiting production. That may have been a little bit of analysts and journalists trying to explain why prices were rallying, when in truth the rally was probably more driven by the movement in China than in real supply and demand issues. But nevertheless, it doesn't look like we're going to keep production levels at the same level that we saw in June. To be relatively conservative about production, we've taken production down basically to the 5-year average over the balance of the marketing year. And given our assumptions about exports, that leaves Malaysian palm oil ending stocks at 2 million tons, which is kind of a psychologically important level. Above 2 million tons is probably a lot more bearish than just below 2 million tons, even though it shouldn't necessarily be that way. So if production is a little bit larger, there's a better chance that that ending stocks will end above that level. If it actually falls below this 5-year average in the coming months, there's a better chance that it finishes below that level. If it does, palm oil prices, which have rallied really sharply in the past month, are probably at a level or close to a level that represents fair value. If production is significantly above that level, then palm oil prices probably will remain on the defensive. The other variable in that equation, obviously, is exports. And what you saw is a big uptick in exports in June, due in part to the fact that the Malaysian government reduced the export tax on palm oil to zero, and China needed to buy. We looked back in the past at times where there have been changes in the tax regime. It typically is sort of a 2-month window when you get relatively large exports, and then after that, everybody is sort of stocked up, and so they fall back down to levels that they were before the change in the tax regime or slightly below that. That's kind of the assumptions that we've built into our forecast, and so that obviously will also have a big impact on where the ending stocks level is. But I think right now probably the market is more focused on production, if for no other reason than you've had these stories out talking about the excessive rains and the labor shortage. My comment on both of those is that if there's a labor shortage, it didn't seem to be there in June, and so unless all of the migrant laborers that helped produce that much palm oil in June went home, I would think that they would still be there in July, or at least the means to produce that level again would be there in July. On the rainfall, there may have been, there were good rains and there may have been some localized and transitory flooding, but that's probably not a problem going forward. And I think that the rain will be good for production in the longer term. It was a little bit dry earlier in the year, and one of the best ways to sort of get fruit trees to produce a lot of fruit is to stress them a little bit and then give them good conditions. So given that, I would say that 6 months from now, production of palm oil should be pretty robust. For China, this just shows the weekly crush and port stocks of soybeans. We've talked a lot about the Chinese demand. Really what has happened is there has been some political tension between China and Canada, and that has resulted in China reducing canola seed imports and canola oil imports from Canada. And that has kind of left a big hole in their vegetable oil balance sheet that they're needing to fill. They bought a lot of soybeans from Brazil, like we said, and those are starting to arrive, as you can see by the port stocks data. So they should have sufficient soybeans to crush in over the next several months anyway. the big question here is, and this goes beyond the soy complex or the vegetable oil complex, the big question is China buying a lot of commodities in preparation for some blowback from the coronavirus or just generally increased political tension with the rest of the world? You saw another big announcement of a corn purchase today from China. And while the purchases so far from the US haven't driven the corn market substantially higher, at least to me, the size of the purchases and the fact that they've come so close together have been a bit surprising given the level of the TRQ for Chinese corn imports. They bought about roughly half of the TRQ already. And it looks like they're kind of doing that in some other commodities too, and they may do that in soybeans and vegetable oils as well. If they do, strong Chinese demand is going to provide support for any of these commodities that they are purchasing in. Of course, it's in their best interest not to let the world know that that's what they're doing, and they're really good at buying stuff, to be frank. And so I wouldn't expect them to come out and announce, that they're going to buy 50 million tons of soybeans or something like that. But keeping track of the purchases that they make in the coming months will probably give us a good idea of what they're actually doing. So to get to our forecasts for soybean oil, you can see we don't expect a ton of upside. We expect prices to, because of the supply and the hedging pressure that comes along with that, we expect prices to maybe drift a little bit higher as the economy recovers. The upside price risks really are the general upside price risks for this time of the year, and then you throw potential Chinese demand in there. On the downside, again, pretty much mostly the general downside price risks. Throw the pandemic resurgence in there. And then there's one other thing that could have a pretty substantial impact on soybean oil prices, and that is small refinery exemptions from the EPA. A couple of months ago, all of a sudden, you saw a bunch of applications for small refinery exemptions for prior years. So for 2011, 2014, on and on. And this was done in reaction to a court decision that basically said to get a small refinery exemption this year, you need to have had a small refinery exemption in a prior year. So far, the EPA hasn't really given any indication of whether they're going to grant those or not. But if they decide to grant those, that opens up a whole can of worms for the biodiesel industry and could allow or could result in a significant reduction in the amount of vegetable oil that's needed to produce biodiesel. So that's a potentially big downside risk. I don't know that there's a huge probability that that will happen, but it's something that definitely needs to be closely monitored. For palm oil, we think that production will probably be at that 5-year average or above, and with slowing exports, we think stocks probably build to that 2 million ton level or slightly above that 2 million ton level. Given the run-up that we've seen, we think that they're probably a little bit overvalued right now. Again, the wild card is China and their demand and ultimately what they decide to do. And then the typical sort of rising crude oil prices or that kind of thing. On the downside, there's been some running political tension between Malaysia and India. That kind of goes back and forth. In India, they also have a bumper soybean crop this year, or at least it's gotten off to a good start, and the monsoon has been really good this year. So I don't know that they're going to need as much vegetable, or their vegetable oil imports are going to be quite as strong as they've been in the past, maybe just fractionally lower. But if you had a flare up in political tensions and they've got enough soybean oil to offset some imports, that's something that could also cause some downside pressure. And then for Chicago canola oil, we expect prices to remain sort of close to the current level before weakening a little bit. The weakness is mostly seasonally driven. Like we said before, we expect the market to remain relatively well supplied, but demand remains relatively strong. The one thing that we would note here is that the spread between canola oil and soybean oil actually was relatively narrow in recent months, and we expect that to probably widen back out a little bit. The long-term historical average between canola oil prices in Chicago and Central Illinois soybean oil prices is about 9 cents. It had fallen below 6 cents. And so that spread probably widens back out a little bit. But we do expect a little bit of seasonal pressure. And with that, I'll open it up to any questions.
All right,
Frankly, I
Tori.
guess.
Yep, we have a couple questions here. Do you have any perspective on palm kernel oil or crude oil, coconut crude oil?
We do track both. I don't look at those as closely as I do the others. For coconut oil, I know that that production has been in a long-term sort of decline because for a very long time, coconut oil production in the Philippines was not hugely profitable, and so reinvestment in the trees and stuff like fertilizer and that really kind of suffered. With the advent of coconut water, you had the bonus of more demand, and so a really sharp uptick in coconut oil prices several years ago. But you also had a reduction in the supply available because when they process coconuts for coconut water, it takes them out of the supply for coconut oil. It looks like production has been a little slow recently, but again, with the improving weather conditions, I think that it probably improves a little bit. Palm kernel oil trades in a relative range to coconut oil, and again, I just haven't looked at that in the recent past, but I'll get the name of the person that has asked this question, and I'll follow up with you after the webinar.
Sounds good. Another question we got here is, what about high oleic soybeans and soybean oil prices?
So we don't really track that very closely. People have been asking me about high oleic soybean oil for years and years and years. And there was a time that we met with the one of the big soybean trade associations, and they were really fired up about it like 4 or 5 years ago. It just hasn't caught on in the way that I think a lot of people thought it would. So we haven't, and frankly, there just isn't a ton of data about it. So we really don't track that very closely.
Okay. Next question we have is, there are billions of pounds of various fats and oils headed to the renewable diesel space in the next 18 months. How do you see this affecting domestic veg oil market?
So the way that we do our forecasts is we basically start at the top of the biodiesel, or we start with the biodiesel mandate, which I guess I think of as the top of sort of this model. It's not a great way to think about it, I guess, but that's the way I think about it. And we build the mandates to reflect what we think is actually going to happen. And then we translate those mandates into, ultimately using the EMTS data, into monthly biodiesel, renewable diesel, and co-processing demand for various feedstocks. And then we incorporate that into our forecasts. And so as that demand grows and grows substantially, and we look at a couple of different scenarios. Under the high demand scenario, you can get really, really, really bullish on vegetable oils and in fats prices. But we have been doing this way for a couple of years now, and I've got to say, we have the realized demand has fallen short or just short of sort of the median scenario the whole time. So when we first did this, I got really, really excited about soybean oil prices and all vegetable oil prices. But as the data has come in, it's just you haven't seen that tick over yet to where that demand is substantial enough to really have a significant impact on prices. I think eventually it's going to happen. I think that as more of these co-processing plants in particular come online, and as renewable diesel production grows, that in more states adopt LCFS type programs like California, I think that day is going to come. But I have a hard time understanding or predicting whether that sort of transition is 2 years from now or 4 years from now, because honestly, the first time we done it, the first time that we did our projections, I would have guessed that we would have been closer to that tipping point than I feel like we are today.
Okay. Tori, we probably have time for about three more questions. It sounds like canola demand is very robust. Is all that driven by cooking oil demand?
A lot of it is driven by cooking oil demand. The health benefits for canola oil really have caused, and this happened years ago, but caused a big shift in consumer preferences. On that per capita usage slide, you can kind of see where that occurs because there's a tick down in soybean oil as canola oil really starts to take off. And so most of that is driven by cooking oil. In addition, the biodiesel demand has been relatively weak I guess it's been declining over the years because of the relative expense of canola oil relative to other feedstocks. Um, that probably continues until there's a pathway for canola oil to be turned into renewable diesel. Once that happens, if you have the strong cooking oil demand, and then you also have people that want to use it as biofuel, that again, that's how you start to get really, really bullish on these vegetable oil prices.
Okay. Tori, how is the recycled oil market impacted?
The recycled oil market impacted by the
That's
coronavirus?
correct.
So if you think about it's really impacted on the supply side. If you think about that big reduction in away from home food spending, all of that is basically taking supply out of the used cooking oil market, right? Because restaurants aren't open, the supply just isn't available, and I don't collect my grease to sell it to somebody that then turns it into biodiesel. And so, as long as you have the shutdowns and as long as restaurant demand is below where it was before, used cooking oil supplies are going to be limited. And that's going to result in a shift in the feedstock mix for, in particular, renewable diesel that goes into California because of the valuable credits that it generates. It probably doesn't shift so much into soybean oil, although there probably is some of that, but probably more likely it shifts to other low CI feedstocks like tallow or choice white grease. Now, the production of those was also impacted by the coronavirus. And so I think in part that's why we saw a relatively larger slowdown in renewable diesel production than we did in biodiesel production, was just because the feedstock availability dropped so dramatically so quickly.
All right. And Tori, the last question that we have here is how would a vaccine for coronavirus affect your outlook here on veg oil prices?
So it would depend a lot on the timing of vaccine, because of this idea of we're not sure how many restaurants will ultimately come back, right? And so I think if we had a vaccine tomorrow that everybody decided was safe and they were going to take it, and so by this weekend we were all back to our normal lives and everything was good, I think you would see a huge rally in probably a sustainable rally in world vegetable oil prices, because you would have all of that demand coming back in a relatively short period of time. Each day that goes by, you get more restaurants that are closed and are going to be closed permanently. Again, you probably, once we do get a vaccine, you probably will have new restaurants that will open up. But of course, that probably takes longer than it does to hire workers back and reopen a restaurant that was temporarily closed. And so, depending on the timing, I could either see a huge impact in a big rally that is sustainable, or a big rally that gets sold off, at least initially, because the demand really isn't quite there yet. And I guess I would suggest that sort of the tipping point for that time frame is probably sometime late this year, maybe early next year. Again, it's really hard to understand exactly how many of these restaurants are going to remain closed. You see things, stories that suggest 25% of the businesses on Yelp are going to remain permanently closed, and you just have no way to judge the accuracy of that. But that's really what it's going to come down to.
All right. Well, that's all the questions we have time for. Thank you to all the attendees for jumping in here. All right, Tori, thank you for your time, and we hope to see you guys on the next webinar that we do.
Thanks, everybody. Thanks, everybody, for taking time out of your day to join us.
All right. Bye, everyone.